From New York City for our viewers worldwide, I'm Katie Greifeld. A hot jobs print sends yields up, stocks down. The countdown to the open starts right now. We begin with the big issue, and that is Jobs Day in America. So let's get straight into the number with Bloomberg's Mike McKee. And wow, this was a beat.
I saw your jaw hit the floor when this happened. It certainly is a surprise. We come in at 272,000. The forecast was for 180,000. The whisper number was only 168. So a significant beat. There is a net revision of 15,000, most of that coming last month in April, revised down from 175 to 165. The unemployment rate, another surprise as the labor force grows, but employment falls significantly, 408,000 in the household survey, and we jump up to 4.1% unemployment rate. Average hourly earnings, also a surprise, at 4% unemployment rate, 4.1% for average hourly earnings, which was not a complete surprise because there were some calendar quirks, but it does give the Fed something to think about. Hours worked, no sign that any companies are cutting back. Now, if you do have a tinfoil hat, you might consider putting it on today. Take a look at this difference between the household survey and the establishment survey. 272 in the establishment survey and a drop of 408,000 in the household survey. People are going to question which one is more accurate. Those who think that the economy is falling apart are going to go with the blue line, and those who think the Fed maybe should be considering raising rates are going to go with the white line, and you guys can fight it out all day on various social media. Where the jobs are and aren't: service industries, 204,000. That's the one that the Fed is watching. Are we still seeing strength that might be pushing up wages there? As always, education and health lead the way, leisure and hospitality, a big rebound there, as there was in construction, and many of those jobs are lower paid. We saw a rise in lower paid jobs during the month. Temporary help, though, usually a sign of things to come, down 14,000. We'll see if it's any kind of harbinger or not. I want to point out the average hourly earnings. There was an extra couple of days that put us in the survey week in May that put us past the normal paycheck month, the 15th, the day of the 15th, and that may have added to this. When you go out by 3 digits, you can see there was a big change in the month-over-month number of about 15 basis points. So we did see wages go up significantly. Is it a problem? And then finally, I just have to tout a new feature of our ECAN option here. Call this up. You can see the breakdown of what happened with unemployment during the month, and in the month of May, much of it was additional people who were completing temporary jobs as opposed to leaving their jobs.
All right, Mike McKee, thank you so much. Let's get to Washington and Bloomberg's Joe Matthew.
Welcome to our TV and radio audiences worldwide. Welcome to the Labor Department today. We are here with the Acting Labor Secretary, Julie Su. And Secretary, it's great to see you this morning. Thank you for joining us on another Jobs Day. We've got a bit of a mixed signal here in this jobs report. More payrolls than expected and a higher unemployment rate than expected. Which survey, household or establishment, is reflecting reality?
Well, this is another very strong jobs report. I'm not going to get tired of coming here and telling you that we are continuing to experience very strong, stable, and steady growth. So it's 272,000 jobs created last month. The unemployment rate has remained at or below 4% for 30 months straight. That's still the longest since the 1960s. And at the same time, real wages, over the year are up 4.1%. So workers are doing better in an economy in which the president has said, when we focus on workers and worker well-being, we're going to do what's right for the economy and for the country.
When you look under the hood, you find that 400,000, even more than 400,000 people left the labor force in May. The participation rate is not back where it was before COVID right now. How do you explain that?
Well, so let's say, the prime age labor force participation rate remains very, very strong. And it's worth noting that, again, women's labor force participation rate hit another historic high. So last month we said it was the highest since 1948 when this data was begun to be collected. It's now a little bit higher than that even. So women continue to power our economic recovery. At the same time, we are seeing, again, strong participation. People are in the job market. People have come off the sidelines. People are looking for jobs, and they're finding them. Where there has been a little bit of a, very small uptick in the unemployment rate. Again, still at or below 4% for the longest stretch in decades, but has to do with young people ages 20 to 24 who are in a bit of transition, really, if we think about May, right? May is a period of transition for all of us parents with kids who graduate and maybe move and, are looking for different jobs during that time.
You can tell a great story and put a great headline number on that unemployment story, as you are right now. But when you look under the hood, you do see some elements of weakness compared to the payroll survey. And I wonder, while you're happy where it is now, if you worry about where we're going to be 6 months from now, if this is a slowing job market.
Well, the payroll survey really is the gold standard when it comes to the unemployment rate, right? This is the, it's the largest by far of any data set, including the household survey, that is used. And so, again, I don't think there's any way to paint this as other than continued strong, stable, and steady growth under President Biden's leadership, and proof of his theory that if we invest in America, we can create good jobs in communities and, crowd in private investment in order to do that. And as I travel the country, I'm seeing the benefits of that.
We've talked a lot about the impact that immigration has on our job market. Can be for better or worse, depending on the trend that you're looking at. And there's an analysis from Steve Englander at Standard Chartered Bank that we looked at this week that estimates about half of the job growth since October can be attributed to undocumented migrants, that it's somewhere in the area of 109,000 a month. If the president's executive order put in place just days ago lowers the threshold, lowers the numbers of undocumented immigrants entering the country, what does that mean for the job market? Do you see numbers like that in your modeling?
I mean, I haven't seen that study. I would actually question those numbers based on what we see. Right? This is a situation where, one, we're not talking about dividing a small pie into smaller pieces. We're talking about a much bigger pie overall. So more jobs, more people in the labor market, more opportunity for all. Since the president came into office, again, we've talked about this, about 15 million jobs created. That is 15 million families, 15 million individuals who are having the benefits of a good job that might not have had that before. I would also say that it is true that there has been, immigration-based growth also, and that has been true throughout our nation's history, right? That immigrants have helped to do jobs and help fuel the economy, but the majority of this job growth that we're talking about has gone to native-born workers.
Well, talk to me about the other side of this story, and that's immigration reform. H-1B, H-2B. We spend all day talking about border security in Washington. What does our job market need in terms of attracting talent from other countries legally?
I mean, it's such an important question, right? This is why, since day one, President Biden has called for the kind of comprehensive immigration reform that would address, some of the challenges that our system has created.
What would our job market look like with that help?
What would our job market look like with
if you got that reform?
Right. Well, so we do administer. We have in this administration increased the number of H-2B workers that have come in. We recently did a rule around H-2A workers, making sure that when migrant workers come to this country through legal means, that they're also protected, right? That they are protected for their own good, but also so that their being here doesn't take away from the good wages in those industries. So we, but the bigger picture is that there does need to be comprehensive reform. The president has called for that, and frankly, Congress needs to do its job. There's
something that I don't want to get too deep in the weeds called the birth-death model that our analysts at Bloomberg Economics are looking at that would suggest some of the companies that we've seen closing might not be reflected yet in the numbers that we saw in this monthly survey. Based on layoff announcements, corporate closures, where do we look in the middle of summer when these numbers start to emerge? Well,
we will come out every month to report the data that we have, but everything that we have seen this past month, this past year, as well as the last year since President Biden came to office, is historic job growth. More jobs created during the same time period than any president in our history, and continued low levels of unemployment. Again, historic lows, and more opportunity to come, right? The investments in the president's Investing in America agenda, many of them are still coming out. And that's why this summer I'm going across the country talking about Good Job Summer, and focusing on the importance of what a good job does for families.
The Good Job Principles Summer Tour. You're like Beyonce. You're launching a national tour, and it's not a mistake. I see some of the states you're going to, like Pennsylvania and Michigan. What is your message to voters in those states?
Well, my message to working people is that we see you, we have your back, we know that you have talent and desire, and we want to create the kinds of opportunities that will allow working people to have a good job where they can be paid a living wage and live a secure life. And our message generally is that when you build a workforce that is ready, that is trained, that is skilled, that pulls the full talent of the American people, it's good for employers, it's good for our economy, and we see that time and time again in these jobs numbers.
Yeah. Getting back to the household survey, which is important to us and our viewers and listeners, the fact that it reflects agriculture, the fact that it reflects what's happening in people's households, does that not raise the level of importance of the household survey at this point when we look at that against payrolls to get a sense of not even as much where we are now, but where we're going?
I mean, I think the bigger, the answer is the payroll survey is the survey that tells us how many jobs have been created, what industries they've been created in. And again, the growth we're talking about is not just single industry, right? It has been for the entire time, but certainly this last month is no different, very, very broad-based. We saw growth in leisure and hospitality. We saw it in construction. We saw it in professional services. We saw it in healthcare. And so, there's really, the numbers don't lie. It's really, a broad-based, solid, continued growth. And I think that coveted soft landing that so many people bet against.
Well, I haven't even mentioned that yet. It's my job to ask you if we're in the soft landing. I haven't heard words like Goldilocks this morning. What's your broader 30,000-foot view on that? You're looking at your slice of the economy, that's the labor market. Is a soft landing intact?
I think so. I mean, again, it's the kind of thing where we're always vigilant about where the economy is going. But based on where we were, remember, in 2021, right? The president came into office, COVID was raging, there was no national strategy to address it, unemployment was very, very high, people didn't know if they were going to get toilet paper if they went to the supermarket. And now we have historic job growth, low levels of unemployment. I think it is the very definition of a soft landing.
You mentioned COVID. It's not the first time we've brought this up as a barometer, maybe a baseline for where we are now versus where we were before the pandemic. It's still impossible to forecast, isn't it? You see these payroll numbers blowing off the charts based on estimates not just by the government, but by Wall Street and economists who are a lot smarter than I am. When will we be able to get a handle on what comes next?
Well, I mean, I think the reality is that's why we don't look at any 1 month's numbers as over relying on them to tell a story. But the story of this economy from January 2021 until now is of steady, stable growth, shared prosperity, and more investments to come. We know that that there's more work to do. We're also seeing the lowest levels of black-white unemployment in a very long time. So it's equitable growth too, and that matters a lot.
What would a second Biden term mean for the job market?
I think we continue to deliver, right? We continue to build a strong economy. We continue to invest in American industry in a way that hasn't been done in decades. So building, restoring roads and bridges, making sure that every family who turns on the faucet gets clean drinking water, making sure that everybody breathes clean air and has access to high-speed, reliable internet. Those are the kind of infrastructure investments. We want to build the things that we invented, right? So bringing manufacturing back to the United States, I think it means, continued opportunity for the American people.
Will you still be in this building if there's a second term?
Well, I don't want to make predictions about that. I do serve at the pleasure of the president, but it has been an honor to help to deliver on that vision.
Well, I'm glad you could join us on another Jobs Day, and we'd love to meet you back here in a month.
Thank you.
Thanks for the time, as always. The Acting Secretary of Labor, Julie Su.
All right, our thanks, of course, to Joe Matthew, of course, with Acting U.S. Labor Secretary Julie Sue. And let's get more reaction to today's jobs data. And joining us now, I'm pleased to say we have Rieder. He is BlackRock Chief Investment Officer of Global Fixed Income. And Rick, you take a look at the bond market right now, and the reaction is dramatic. You take a look at 10-year yields up double digits in terms of basis points. Have to ask you about the rate cut outlook. We see those bond rate cut bets being pushed out all the way to December. Where do you fall?
So, by the way, the gyrations in the bond market over the last 2 weeks of the extremes are pretty incredible. So we're taken out. By the way, this morning, pre the number, we were pricing in almost exactly 2 rate cuts for the year. That didn't give you any room. So now you're repricing it to a level that I think is more realistic. Listen, I think the Fed would still like to get a cut or two done. I don't think this, is going to put more of a focus on the inflation report, and including next week. But I still think they would like to get a cut done. I still think September you target as doing that. But listen, the economy is, if you take, you have a first derivative of growth, the U.S. economy is slower. But you have to squint to see the slowdown. People have talked about, my God, this thing is falling off a cliff, we're stagflation. It's just not true. You've got a good economy that at the margin is moderating, and I think today's data is reflective thereof.
And it's a good reminder, too, that the narrative could completely change when we get next week's CPI report. But even still, you mentioned that this is a Fed that would still probably like to cut. But should we be entertaining the possibility of a hike at this point?
Negative. I think I think the Fed, I think Chair Powell was pretty clear about rate is restrictive. And I said this last week on your show and a couple other things. Listen, you're not actually cutting inflation by keeping the rate high. In fact, the dynamic that plays out, and you see it's a good article in the Wall Street Journal on this yesterday, you pump more income into the system because the people that are spending, the U.S. economy has become much more of a creditor versus debtor because you had this massive amount of money that came into the private sector from fiscal. And so you actually just get a recirculating of income when you keep the rate this high, but it really hurts lower income. So point being, to hike rates makes no intuitive sense. To actually start to bring it down to a level that's merely restrictive, we think makes sense. So do you very slowly get that rate down to a level that's restrictive? Listen, price stability is a Fed's mandate. Your 2.8 on core PCE, probably staying around there, maybe a little bit lower. But what you're starting to see very slowly, and you got to marry this to the JOLTS report, which I think is more indicative of the future. Some of these areas, job openings, we had a peak of the JOLTS report job openings of over 12 million jobs, down to 8, almost exactly 8. Things like, it's interesting today, you look at leisure, and I was like, you're seeing the bounce there. But if you look at the JOLTS report, job openings from the peak have come way, in accommodations, restaurants, retailing has come way down. So anyway, I think you got to balance it. I think you'll see the data from here in jobs start to come off a bit. But listen, the Fed's got to see it. And so you sit on your hands a little bit, get some more data. I think that's where we are.
I don't know, Rick, you think about what we heard in the JOLTS data, what we saw from ADP and then NFP today, kind of felt like we were talking about different countries. But in any case, I'm glad you brought us to your comments from a month ago that basically it's a cut now, not a hike, that's needed to tame inflation. And looking through your comments, it seemed like you were really talking about the wealth effect here. You think about the fact that when you look at fixed income investments, you're earning a yield here, and probably consumers and savers feel a little bit wealthier than they did in years past.
Yeah, I think people underestimate there's been a massive demographic shift. The biggest spending cohort in the economy today is people 65 and above. Think of what's happening. Those are your savers. Those are the functional creditors of the economy. And it's actually interesting. When you look at the savings rate stays low. Why does it stay low? Because they're still getting income pumped into their coffers. So what happens is they recirculate that money. Why do you see things like entertainment, healthcare, insurance, recreation, restaurants, that inflation level stays high because you're getting this dividend into their savings. So the two things that have happened: one, massive shift from the public sector to the private sector in terms of them becoming net savers, and then obviously this aging cohort that's been incredible. One last thing: when the Fed kept rates really low for a long time, companies termed their debt out. Individuals, even with the mortgage rate. Why the mortgage rate doesn't really, affect us. You don't see much in the way of housing starts. So people locked in their mortgages. So what's happened is debt was termed out. So the interest effect is not that significant. and obviously you had those other two shifts. So it's a very different. People say traditionally you got to hike rates to bring down inflation. The data and the environmental ecosystem is quite different than anything we've ever seen before, where you actually cut more income into the system when you put this kind of interest rate into the system today.
And I want to get to how investors should be thinking about that. But before we move on, I want to talk about the wealth effect a little bit more. So what you're describing when it comes to fixed income investments, money market funds, a very powerful force on the economy. Do you think that it is more dramatic when it comes to the wealth effect coming from fixed income rather than the wealth effect that comes from the stock market?
Both are so hugely important. Both are hugely important. So you get an increase in your net worth from obviously the wealth effect that takes place, but also the income coming in. It's actually good what you bring out. It's a combination of the two that are creating that phenomena. And listen, by the way, there's still, like you say, a huge amount of money sitting out there, money market funds, bank deposits, that is getting that income effect. So it's the two of them combined that are creating this influence, which is actually truly extraordinary. Here's the dichotomy in the economy, the paradox that I think is a problem. The people that are borrowing, low income, small business, local banks, get pressured by the excessively high interest rate. And those are the borrowers. You're seeing this in credit card charge-offs, delinquencies, auto loan delinquencies. Point that I would make is you need to, over time, get that rate down to a restrictive level, not overly restrictive, because you're pressuring a good part of the economy. And I would argue unduly, given what is that high rate today.
And well, let's talk about where the neutral rate could be, where the Fed eventually settles up, because the bond market currently pricing that in around 4%. You have the Fed probably somewhere between 2 to 3%. What's the Rick Rieder view?
So I think when the Fed starts moving, the terminal rate's coming up. So think about what happens. And by the way, the Fed can execute this by not creating a financial stability, easing of financial conditions of significance. I think what happens is you bring that short-term funds rate down, you keep the terminal rate a bit higher, and you ultimately, to me, it doesn't take much to get the funds rate down to 4.5. But then then it's questionable you're going much lower than that. We're going to be in a higher inflation environment for a period of time. So point being, I think the dynamic is, gosh, should we go to 4.5? I think so. But are you going to go further than that? Certainly in the foreseeable future, maybe not. So that's where I think, we're going. Part of why, I think you can get some steepening of the yield curve, but gosh, I don't think long rates are going very far from here. People have talked about, we're going down dramatically. I don't think so. And part of why, we've talked about it together on the show. Part of why I like creating income and fixed income. I know we talked about our ETF, this BINC ETF. Like if you can create, and now today, like you can create close to 7% in fixed income without really stretching in terms of credit quality, in terms of emerging market debt, et cetera. That's pretty attractive for people today.
Well, Rick, let's go right there. Of course, your ETF, the ticker is BINC, of course, BINC there. And it's interesting, you take a look at your allocations, and you're pretty much more in high yield than anything else. That's about 40% of your portfolio. And I think that's pretty interesting because then you take a look at the duration, you're pretty short. It seems like credit risk is where you're more comfortable right now.
Right. By the way, there's high yield and there's high yield. We like single B U.S. high yield. We like double B European high yield. By the way, you don't have to take the risk in triple C. I don't think we own any. I'm certain we don't own any triple C high yield. Like, why take the risk? You get plenty of yield from staying in credit quality. By the way, I would argue today's high yield, a double B high yield company, because they term their debt out, there's no maturity wall, is pretty darn close to an investment grade credit. So the point being, stay higher in high yield. Use some investment grade credit, which we are today. And yes, Katie, I think I've been doing this a long time in credit. It's as good as I've ever seen credit quality because they termed their debt out when rates were at 0. And so they're sitting on very little maturity wall other than parts of the lev loan market. So anyway, I like being in credit. I also like securitized assets. Things like AAA CLOs, because they're floating rate, because you actually get enough spread, you can create mid-6s type of yield. And by the way, being a AAA asset, there's a lot of stuff you can do without stretching. We like the better, taking a little bit of EM, but only in the highest quality parts of EM. Like, if there's no reason to stretch today, to get these type of yields.
And Rick, I mean, to that point, actually, Bank of America had a note out earlier this week saying that if you take a look at double B bonds and triple B bonds, that border is getting blurrier and blurrier. To your point that this is a higher quality, high yield market. But before I let you go, I want to go back to the yield curve, because that yield curve steepener, it's broken a lot of hearts this year. It was one of the highest conviction trades coming into 2024. Just hasn't worked. And I mean, listening to you talk, it sounds like it might not work for the foreseeable future here.
So listen, I think that trade, I mean, people want to get into that trade, and then I find it, I find doing that tactically is, either better alpha sources. Quite frankly, I just find clipping income and using the front to the belly of the yield curve to clip income, like you said, keep your duration at a moderate level and just keep clipping income. There are some exogenous things that keep the back end well pinned. Pension demand comes in, life insurance demand comes in. Listen, I think playing for the steepener, if you said to me at the margin, would you be in a steepener versus a flattener? I'd be in a steepener. Would that be my primary way to generate return in fixed income? I think there are easier ways to do it.
And 30 seconds before I let you go, what do you need to see before you go out the yield curve and increase that duration?
Well, so first of all, I mean, listen, the Treasury is going to issue an awful lot of debt out the curve. I don't find the back end that interesting at all, unless you're a pension, unless you have a long-dated liability. It's going to take a lot. But could you go out to the 7 to 10-year point? I think so. But I think we got to get on the other side. Listen, if you got a good inflation report next week, would you push would extend out a little bit? You need to see persistence of that core PCE metric, and in particularly service level inflation. You need to see that start bending down, and then you could push it out a little bit. But gosh, I would argue today, I would add more duration. We will add more duration, but more in that belly of the yield curve. And particularly days like today, where you get nice backups, but I don't know, to go out the yield curve and a flat yield curve to take more volatility in your portfolio, I just don't think it's that interesting.
All right, Rick Rieder, it is always great to speak with you, especially on Jobs Day in America. Our thanks, of course, to Rick Rieder of BlackRock. Have a great weekend. Meanwhile, you take a look at these markets with just a couple minutes to go until the open, and you can see S&P 500 futures coming back a little bit. Still down, but we're only talking about 0.3%, a little bit better, too, if you take a look at the NASDAQ 100, currently off by about 0.2%. The big action is in the bond market. That 10-year Treasury yield currently higher by about 12 basis points. Now coming up, we'll speak to Morgan Stanley's Andrew Slimmon on the impact of the jobs report at the opening bell next. This is Bloomberg. This is the countdown to the open. I'm Katie Greifeld. We are moments away from the start of trading. You take a look at the board behind me. It's still red. The S&P 500 down about 2%, or rather 0.2% in the pre-market. Same thing if you take a look at the big tech index, but really coming back from what we saw after that blockbuster jobs print. Let's take a look at the cross-asset board right now, and you can see all of the action really in the bond market. The 10-year Treasury yield currently higher by about 12 basis points or so, a much different reaction to what we're seeing in the stock market. Meanwhile, you take a look at the FX picture. Euro USD, that pair currently camped out at 108. It's been there for quite a while, and crude moving a little bit higher right now, 0.4%. But one stock to keep an eye on at the open, of course, is GameStop. It has been a wild ride as Keith Gill plans his YouTube return, and the company announced that it would sell up to 75 million shares. Simone Foxman has more.
Yeah, Katie, all eyes were on this 12 p.m. Live stream, and that's in Eastern Time, New York. But then the company kind of getting in the way of this wild rally. We saw shares up 47%, over 47% in yesterday's trading, and they continued over 30% in the post-market, and then fell this morning in pre-market trading. We've seen those losses mostly continue. It was down almost 20% after the company first announced first quarter results. It did that early. It announced a net sales decline of 29% year on year, a loss of 12 cents a share. There aren't many analysts that actually follow this name on a regular basis, but this was higher than they anticipated. And then it announced that plan to sell 75 million shares. Mind you, it had already sold $1 billion, raised $1 billion in a share sale last month. So that's where we stand as we head into this highly anticipated YouTube presentation at noon. No one understands exactly what Keith Gill, Roaring Kitty, is going to say, but the expectation is that he owns a lot of shares, perhaps one of the top 5 owners of GameStop shares at this point. So that's what we are going to be watching today in meme stock land. Katie.
I like that you called it a presentation because really we have no idea what's going to happen at 12 noon, but theoretically we're going to hear from the cat himself, Simone Foxman. Thank you so much. Let's turn over to earnings now because ski operator Vail Resorts missing revenue estimates and cutting its forward guidance for the full year. Natalia Kunijevic has more.
So Vail Resorts cut its guidance, and the number came almost $30 million below what analysts had expected. So this company operates and owns mountain resorts and provides services like ski schools or golf lessons. And what's been happening quite lately with the company, there was a huge demand for travel after the pandemic, but now it's normalizing. And on top of that, last winter was warmer than expected, and it's getting more and more expensive to travel. We see that not just across low-income consumers, but high-end consumers are traveling much less. So the company posted a huge decline in sales of its ski passes. What normally happens, it starts selling ski passes from March till the beginning of the next skiing season. And the number we got today was from March till May. And that number was very disappointing for many analysts. So short term, analysts, including Jefferies, they see challenges coming from warm winter and lower demand. But longer term, they expect that capital investments will provide some growth for the company. And it's shifting its strategy a little bit because over the past 15 years, it has been buying U.S. ski resorts, but during the past 2 years, it bought 2 European resorts, so maybe it will provide more growth, Katie.
Yeah, we'll have to see if that actually plays out, but right now a total wipeout when it comes to Vail Resort shares. Natalia Kunijevic, thank you so much. Let's turn now to EVs because a Tesla investor suing the car maker to challenge a proxy vote on its move to Texas and reapproval of a $56 billion pay package for Elon Musk. Ed Ludlow has more, and let's talk about the pay package and of course that vote coming up next week. What's the expectation right now?
Hi, happy Friday.
Hi,
well,
Ed.
Tesla's up 0.4%. It had opened down 1%. This is a suit by a gentleman called Donald Ball, who holds 28,000 Tesla shares. So at $178 a share, you do the math. I'm not going to do it in real time. And he's basically arguing that in asking investors to vote to move the corporate headquarters from Delaware or incorporation from Delaware to Texas, but also the comp package, that Tesla is in breach of its corporate charter because, as the suit alleges, the corporate charter was established in Delaware. And what Tesla is saying is that they just need a technical majority in order to pass those 2 provisions. What the suit is arguing is that that's not the case. Under Delaware law and a charter that's established under Delaware law, you would need a 66% majority. Of course, we have the annual shareholder meeting next Thursday, 4:30 p.m. Eastern Time. I won't be here. I'll be on a beach in the Mediterranean, such is the stress of covering this company. But I'd observed that a very large number of institutional investors, and particularly retail investors, have come out in support of Elon Musk's pay package. So this suit is an interesting development, but it's just the latest twist or turn. There are those that have come out against it. I guess highest profile, the CalPERS CEO, saying that as it stands, they wouldn't vote in favor of that pay provision. But interesting trading this Friday. The stock up 0.6% now, basically flat on the week. I think technically we're heading for our second weekly decline, back-to-back weekly decline for the first time since March. You're somebody that loves data. It's a stock that's down 29% year to date, but on the back of a 100% gain in 2023. You know, it's a really finding a forward direction moment next week, and I'm sorry I'll be missing it.
Yeah, Ed, 2 things there. I cannot believe you're off next week between, of course, this vote and Apple Day, which we're going to get to in the next block. But quickly, before I let you go, when it comes to the pay package, reapproval of the pay package, what if actually the vote says no? What does Elon Musk maybe do.
Yeah, I mean, this is a factor of the suit, and it's the idea that Musk has threatened to go and take his focus on artificial intelligence elsewhere if he's not able to secure what he wants, which is its superior voting rights. It's not necessarily the pecuniary or compensation side of this. He just wants greater control to establish his AI vision for the company. And again, the suit alleges that by putting that to investors, that's wrong per the corporate charter. But many investors back him on that. Many investors come out and said, yeah, okay, if you believe this is the direction to go and you want control to do it, then we back you as well.
All right, well, pessimists might argue that his attention is already elsewhere, but Ed, I take your point there. We'll be catching up with you in just a couple minutes. But right now, let's welcome in Morgan Stanley's Andrew Slimmon for some reaction to what we learned this morning at 8:30, because I think that it surprised just about everyone. Andrew, it's interesting, though, if you take a look at the market reaction, honestly, stocks have come back a little bit. The S&P 500 still down about 0.3%, but holding up remarkably well. What do you make of that?
Look, I would make the argument that strong economy is good for equity. So I would be, on a short-term basis, I'd be buying this dip. And the reason I make that argument is simply that if you think about this year, what has driven the stock market higher is that earnings have come in stronger than expected. Earnings estimates overall cumulatively are higher than they were at the beginning of the year. So if the economy continues to say it's strong, and that's what we're getting today, that's good for earnings estimates, and that's what's driving the market. So at least as it pertains to equities, I think the Fed pushing out when they're cutting is good news.
Good news. I'm interested to hear that, because a lot of people took the fact that you had 6 rate cuts priced in at the start of this year as really a bullish rallying cry. Why is it good news that maybe this is a Fed on hold?
That's completely false. I mean, that narrative. And the reason why is when you think about to year end, okay, on December 31st, when we get to year end, where is the stock market going to be? It's going to be priced off of 2025 earnings, because that's the next 4 quarters. And that started the year, this year, at $275 a share for next year. We're now up to just below 280. If the Fed had cut 6 times, we wouldn't have gone from 275 to 280, because that would have been telling you economy weak, that's not good for earnings this year and certainly not next year. So I think the fact that if you said to me at the beginning, the Fed's not going to be able to cut 6 times because the economy is strong, I'd say, oh, that's good. We're going to have earnings. So I think that's why the 6-cut narrative, good for equities, was completely, flipped upside down. I don't think that's good news at all.
Yeah, so point taken there. And I remember I was anchoring the last week of the year, and we were talking about these 6 rate cuts. And 6 rate cuts, that seems like a recession, kind of like what you were saying. But even still, you think about the speculative fervor in this market, if you want to call it that. Of course, what we're seeing with meme stocks, I'll say it, what we're seeing with GameStop, does that give you any pause as to maybe things have gone a little bit too far?
Without a doubt. Without a doubt. Because if I think back to the previous bear market low, which was in March of 2020, we had a good year in 2020. And then 2021 was only the second year of that recovery, but boy, it was a frenzied year. We had meme stocks, we had SPAC, we had IPO, margin debt went through the roof. So we haven't seen that yet this year, but maybe the meme stocks is just the start of the speculative fervor. One thing I would point out, however, is, and I'm a long equity manager, is the number one pushback I get to equities is, why would I buy equities when I could be 5%, 6% in money markets? And that is, my simple response is because the equities return historically double that. But when you think about that, people don't think that way when you've had a multi-year bull market, because their expectations are double-digit returns. You think that way when you're worried about losing money. And that usually is in the early stages of, bull markets are born on pessimism, they grow on skepticism. That concept of, I like 5% risk-free better, that's those, the pessimism, skepticism stage, not the, mature on optimism, die on euphoria stage.
Yeah, it feels like for every active manager, whether you're in equities, fixed income, whatever you have it, cash is the stiffest competitor right now, even though, to your point, I mean, stocks usually return double that. But I want to talk about some specific names here, because you write in your notes that you take a look at Nvidia. That rally makes sense if you look at the fundamentals, but it's time to look beyond that. And you name a few names. You have Amazon, Google there, and then you have CRH. And that caught my eye because that's a building materials supplier, not exactly a big tech company there, Andrew.
Sure. So the overall thesis, the commonality to all those stocks, however, is that if we look from a factor standpoint, what is the best factor year to date? Certainly momentum, but it's also earnings revisions. So in other words, companies that are delivering on earnings fundamentally are doing the best. And that's a very healthy sign of a stock market. You want companies that are, raising guidance to do the best. Well, CRH is an Irish cement company, but they happen to do a very high portion of their business in the United States, which is why they are in the process of relisting their shares in the U.S. And the reason why their business is doing so well is because we have all this infrastructure spending going on. So their business is very strong through fiscal policy spending in the U.S., but the kicker is it is going to be relisted in the United States, and could it get a revaluation upgrade that would be more consistent with basic material companies listed here in the U.S.
I do think that is a fascinating trend. Actually, earlier this week, we were talking about how you have activist investors really pushing London-listed companies to list in the U.S. for pretty much exactly that reason. But I only have about a minute or so left with you. So really quickly, I do want to point out that you do see a bigger drawdown at some point this summer. What's going to drive that?
Well, if you think about going back to what's worked this year, it's been earnings have been stronger and PEs have lifted. So the very bearish scenario is a whiff of stagflation, because stag means, economy slowing, and maybe that 280 number for next year is too high, and inflation is higher rates, which means PEs are too high. So that's the double whammy that would hurt equities. I don't think that will be the case this year, but I'm very wary of the fact they're going in the summer, the market's strong, and could we get maybe some CPI prints that are too strong, or we get some weak economic data, certainly not today. That would be the scenario where you get a more of a substantial cut than pull back in the market than we saw March, April. And, we tend to get 10, 15% pullbacks once every, year to 18 months. And the last 10% pullback was in September of last year. So we're probably due at some point for that. I just get a little bit more nervous as we go into post second quarter earnings in late July.
Well, I'm sad to say we have to leave it there. Really enjoyed this conversation. Have a great weekend. Our thanks, of course, to Andrew Slimmon. He is Morgan Stanley Investment Management Senior Portfolio Manager and Managing Director. Now coming up, tech stocks flying high.
Tech is kind of in a bubble of itself in terms of its profitability, right? Its earnings. So that's a great story, and I'm not entirely sure we're close to that popping.
We'll have more on tech as investors await an update on Apple's AI strategy. This is Bloomberg.
Is kind of in a bubble of itself in terms of its profitability, right? Its earnings. So that's a great story, and I'm not entirely sure we're close to that popping. What is really interesting to me is that, this AI excitement is capturing imagination from companies all over the spectrum.
Well, nearly 2 years after the artificial intelligence frenzy started, Apple is preparing to lay out its vision for the technology. The company will introduce its long-awaited push into AI at its annual Worldwide Developers Conference on Monday. Joining us now for a preview is Ed Ludlow. He is the co-host of Bloomberg Technology in San Francisco. Of course, you won't actually be here. You'll be on a beach, but tell us what we should be expecting.
Well, and I regret that I won't be at WWDC. I got my invite, and I really and I immediately regretted it, because there's a huge frustration with Apple that they haven't shown their hand yet in what is consumer-facing AI and iOS. What Bloomberg's Mark Gurman is reporting is that they're going to show us something called Apple Intelligence, or AI, and that it's underpinned by their own work and by a partnership, which they should announce, according to Mark's reporting, with OpenAI. And the idea is not to have some kind of dedicated standalone chatbot, although there is a sense that we will see something like that, but basically improve the existing suite of apps that are available on iOS and macOS using artificial intelligence. And, you know, Mark is often right to the letter at these events in terms of his preview and his reporting.
And is this enough to re-energize the stock? You talk about that narrative that Apple is behind in AI, and that has certainly dragged down the stock.
Yeah.
I mean, it's pretty lifeless year to date, only up about 1.3%, Ed.
I know that you caught my column the other day, but the basic premise of it is, if you look at the third-party data, overall the smartphone market's going to recover this year and have around 4% growth across smartphones. But Apple's level of growth is much lower. The forecasts are less than 1%. And what's happening is there's evidence in China consumers are already buying the latest Gen 15 Pros, and that they intend to keep hold of those smartphone systems for longer. Higher price point, they're fine. So it's a really big question in Apple's case in particular, because what Mark's reporting tells us is that these new AI tools, you have to have iPhone 15 generation or later, so whatever the devices they release later this year, in order to get access to the AI tools and AI suite. Will that spur an upgrade cycle? There are those that think they will, and there are those that think that it won't, because consumers can be price sensitive. And they basically look at the AI tools, and there's a large body of consumers out there that say, I don't yet understand how I'm supposed to use generative AI on my phone every day in a way that profoundly changes my life.
Ed, before you sail away, just really quickly, we should talk about Nvidia and, of course, that upcoming stock split. Right now, Nvidia shares will cost you close to $1,200. After they split the stock, will that really invite retail in?
It really will, and a stock split simply works this way. Fantastic explanation in the quick take. It's like swapping a $10 bill for 10 singles. You know, it lowers the barrier to entry, and there is intense retail interest in this name. Go on social media and search for Nvidia and see what's being talked about. Look on Reddit, look on StockTwits. It's just been an astonishing run, and it does not have a dilutory effect. So let's see how it goes. Look at comparisons. Tesla did a stock split. How did that go for Tesla? It went pretty well in terms of the immediate upward trend in the days and months that followed. So definitely one that you guys can be watching for next week.
Ed, we will certainly miss you next week. Have a great vacation. Our thanks, of course, to Ed Ludlow in San Francisco. And for some of the sector price action this morning, let's get to Bloomberg's Simone Foxman.
Yeah, Katie, a narrow majority of sectors are in the red today when we look across the S&P 500. Of course, real estate taking the most hit after that strong jobs data and the prospect, of course, of higher for longer rates. But when we look back over what the past week has been, we're looking at an S&P that is likely to see its sixth out of the last 7 week of gains, and that's mainly on the back of what's happened in info technology. Hewlett-Packard and Nvidia leading here, but that's also had 6 of its past 7 weeks in the green. Communication services, as well as discretionary. It's also been a strong week for discretionary with Norwegian Cruise Lines and Carnival, but comm services there are second best performer. To the downside, you know, you see energy and utilities there, but when you look down into the details of utilities, it's really all about what's happening in the energy space. We saw OPEC Plus announce that it was going to gradually wind down production cuts from October. We saw Brent fall below $80 a barrel, hitting a 4-month low on Monday. That's where the real negativity is in this market, Katie.
All right, Simone Foxman, thank you so much. Coming up, the market-moving events you need to be watching. That's next in our trading diary. This is Bloomberg. Time Time now for the Trading Diary. What you need to be watching through next week. U.S. April wholesale inventories at the top of the next hour. And then Monday, the Apple Worldwide Developers Conference begins. Wednesday is CPI data and the Fed rate decision. And then on Friday, finally, we get the UMich consumer sentiment data. So a lot to look forward to, a huge week ahead. But this was the countdown to the open. I'm Katie Greifeld, and this is Bloomberg.